Hello and a warm welcome. You've joined us on Budget Bulletin on ET Now, and let's shift focus. With the union budget just a little over 15 days away, we continue our expansive pre-budget coverage, continuing your conversations with the biggest industry voices on the big digits we can expect from Finance Minister Nirmala Sitharaman's Budget 2025. From tax reforms to centre's plan to front road Capex, with special focus on infra. But overall, the primary task at hand for the government will of course be their focus on fiscal prudence. Sources tell ET Now that the government is likely to maintain its fiscal deficit target for FY26 at below 4.5%. Let's take deep dive into this story and go across to my colleague Prakash for more details. Prakash, over to you. Help us understand what the story is.
Yes, we are learning from our sources that the government is likely to continue with the current fiscal roadmap in the upcoming budget. We are given to understand that the fiscal deficit target of below 4.5% for FY26 will be maintained. Along with that, the sources are also suggesting that the government is likely to record fiscal deficit of 4.7% for FY25 against the budgeted target of 4.9%, a very significant development coming in. Lower expenditure and a higher dividend from PSUs and central bank in FY25 may help government to keep fiscal deficit target below budgeted target of 4.9%. A very significant development coming in. Along with that, the government has already instructed PSUs and ministries to speed up expenditure in the second half of the current financial year, which is expected to pick up during next 3 months. But the government will try to make a better balance between fiscal prudence and expenditure, as some other factors are also there which needs to be taken care of, and that is of course a market borrowing through dated securities, which is likely to rise in FY26 to fulfill repayment obligations. Of course, these factors will be taken into consideration while deciding targets and of course Capex numbers. But the government is likely to continue with the current fiscal roadmap for the financial year 2026.
Government will continue to focus on fiscal deficit. That's the word coming in. But to discuss this in greater detail, we now have Kanika Parishchita, Chief Economist Advisor at Union Bank of India, now joining us. Kanika, thank you so much for taking your time out. Sources are telling ET Now budget deficit could stand at below 4.5%. Help us understand, what do your workings suggest and where could that figure be this time around?
So, first of all, thanks a lot for having me on the show. Given that the finance minister has given a fiscal roadmap very well in advance, a bias of 4.5% of GDP, consolidation towards 4.5 from 4.9% in the current financial year has already been factored in by the market, and it does seem plausible. Of course, the new news that's coming in, that there's a bias of an even slightly lower number, maybe closer to 4.4%. But what's very important is it is contingent on how the expenditure performance of the government pans out. Even if tax revenue receipts continue to respect the nominal GDP growth levels of 10.5-11% growth, RBI dividend, even if it doesn't clock a record high of 2.1 lakh crores in the current financial year, it gives a number of closer to 1.5 lakh crores. So maybe some levers to be used on expenditure consolidation or calibration. The focus remains on quality of spending, that is higher growth in Capex vis-a-vis the sticky revenue expenditure is likely to make the government achieve that 4.5% of GDP even next year, budget for the same. So close watch on the numbers when the budget is announced on 1st of February.
So that's as far as the fiscal deficit is concerned, but wanted your thoughts on the Capex figure. Remember, this time around in the first half of the year, Capex was on a lower side on account of election, on account of monsoon. But when it comes to budget 2025, what will your expectation be with respect to Capex? Will it be above that 11.11 lakh crore mark?
So frankly speaking, first let's look at this year's numbers. 11.11 lakh crores. The DA Secretary Ajay Sheth, in fact 3 months back itself, has commented that the number is likely to be 95% of the budgeted figure. And it was the same trend, it is similar to trend that was seen even the previous year. So the number is closer to, it's a number closer to 10.5 lakh crores compared to 11.11 lakh crores that's budgeted. That's one. On that, if we pencil in close to 7 to 8% growth on Capex for next financial year, the number may be a tad higher than 11.11 lakh crores for the current financial year. So we don't see a very sharp run-up in Capex growth in the next financial year. Yes, likely to be higher than the initial budget for FY25, but that too in the RE expected to be revised lower to somewhere between 10.5 lakh crores.
Okay, so that's as far as the Capex figure is concerned. But remember, in the last year, because of election, several figures and facts were impacted. Several freebies are expected to be given this year as well on account of state elections. Will that impact fiscal deficit number?
See, frankly speaking, freebies is something that affects state government deficit, and it's actually being witnessed. But the central government deficit continues to remain committed towards consolidation, improving quality of spending, Capex growth penciled in above the revenue or the revenue expenditure, the REVEX growth. But still, this year in the first supplementary demand for grants, the government asked for 50,000 crores extra in REVEX. Now that may be compensated via a slowdown in Capex vis-a-vis budget. So the reduction is likely to be more than 50-60,000 crores that the government has already talked about in order to ensure that the budget balance to 4.8-4.9% of GDP is achieved as per budgeted numbers. Even for next year, with the government committed towards fiscal consolidation, focus towards upping revenue expenditure remains muted in our view, at least in the budget numbers. We'll have to see how things go through. But there's only one more point that becomes very important to look at. Maybe the government looks at, as it does every year, in terms of some farm schemes. But more importantly, the economy needs, what the economy needs urgent addressal is the weak demand situation. That is curbing the broad-based private Capex recovery in the economy. So from that standpoint, any changes to income tax rates will need to be closely watched out for. That's not a Capex or that's not a hit to expenditure, but more a hit to revenue receipts. The hole it can create is much larger, which is why the space to do the same remains limited. But we've got to see what the government does in terms of improving demand levels in the economy in this budget. Thanks.
As far as the demand is concerned, but Kanika, since you are with us and rupee has plunged below that $86.5, help us understand, do you expect any kind of RBI interventions to come in to curb the situation?
See, there are 2-3 points. First is, of course, the RBI in its policy itself is committed towards containing FX volatility. Given globally, we have seen after the non-farm payrolls data in the US, we've seen dollar rising higher, dollar index is inching towards 110 mark. US 10-year is at 4.75. In fact, it's slowly inching towards the 5% handle. Oil back at $80, so for a separate reason of US sanctions on Russian oil. This is actually leading to sharp volatility in rupee. The RBI remains committed to the same as per market sources even today. That's one. Second, do we see further up move in the currency in USD INR? Given that real effective exchange rate was already 8% overvalued as of November 2024, the scope for further pressure on the rupee does remain, especially with dollar strength gaining momentum in the short term. And 20th January, most importantly, a key event risk when Trump joins office and intends to execute 25 executive orders that needs close watch as well. So short-term pressures remain. RBI is intervening to contain volatility as per market sources as well, and it's aligned with their commitments in our view. Are they going to take any additional measures to do the same? I would say they would continue with interest rate defense for the rupee as well. So this actually means rate cuts delayed, or at least degrees of freedom of monetary policy easing delayed as of now. Any further measures via swaps needs to be closely watched out for, though in my view, it's more of a liquidity measure because FX has created a liquidity hole of more than $40 billion in the last few months, more than a direct FX measure where we had seen way back in 2013, those were direct measures to get dollars that was via FCNR swaps. Today is not the right day to implement such measures with such low US-India rate differential. So maybe continue to intervene in markets from rupee standpoint, but also what we are closely watching out for is liquidity measures to plug the FX hole, given the way call rate is standing today above 7% today. Thanks.
RBI will continue to intervene in the currency market. That's the word coming in. Kanika, thank you so much for taking your time out and speaking with us here on ET Now. That's all the time we have on this edition of the show. Closing trades coming up next.